One of the most watched stocks this morning is Disney. The company's latest quarterly results not exactly sitting well with investors. There's a specific issue here. It seems to be the worry about the subscriber outlook. We know Disney has focused a lot of its attention and time and money on streaming over the last few years. They're trying to build a path towards profitability, but in the meantime, what are the biggest concerns on the street? Let's bring in an analyst who's still pretty constructive on the business. David Joyce is with Seaport Research Partners. David, thanks for being with us. Walk us through the story of Disney as you see it. Why do you think the stock's taken a hit this morning?
Yeah, so this report this morning was a mixed bag. You did have some positive surprises, such as the direct-to-consumer streaming business achieving profitability 2 quarters earlier than expected. But there also were higher expenses at the other divisions than expected. And really, I think what it boils down to is that this next quarter coming up is going to be a soft one again for different timing of events affecting the sports profitability, some different events affecting the streaming profitability. But the outlook is more constructive for the fourth quarter, which their fourth quarter ends in September. That's when they'll start cracking down on the password sharing, which definitely helps the subscriber numbers and the revenue. And they pointed out the success that Netflix has had with doing that. And they started that about 9 months ago. And there also will be improvements in profitability, probably generally permanently profitable at the streaming service then. Also, the theme parks will have some better comparability in the fourth quarter. So part of the reason the stock is pulling back is that this next quarter is going to be soft, but I think that there's definitely some constructive things on the horizon just past this next quarter.
And what do you think about the valuation of the stock? Like you're generally upbeat over the long term. How come?
Yeah, I think that the stock is worth closer to $128 than $106 that it's at now. Again, as you mentioned, it did pull back about 8% this morning. You're normally going to have some of that short-termism, but the franchises here are extremely valuable when you think about the long-term earnings power. The theme parks still are driving the profitability. They're still seeing strong demand, although they did say that they're getting back to normalized demand instead of the double-digit growth that you were seeing, kind of post-COVID. But the demand for all their new, the new attractions is still there, and that's all of their. That's really the case for all of their theme parks. So I think that that's one thing that's supporting the longer-term valuation metrics. The other is that you're in this kind of state of flux where you're going from a subscriber or revenue-based multiple on the streaming service to now that it's achieving profitability. Some investors are going to start thinking of what the long-term profitability potential is for the streaming service, and they'll put a multiple on that in the future and then discount that back. So I do think that there is still upside in the shares. I think that it's just the short-termism right now that is causing a pullback. I don't think there's a problem with the franchises. So I would take advantage of this pullback, looking for this to be decently higher within 3 to 6 months from here.
And I guess when we're thinking about the long term, the company is run by one of the most well-known executives in corporate America, in Bob Iger, who of course stepped back into the job, has navigated all of these issues that you're talking about, battled it out with activist investors like Nelson Peltz. Has some battle scars, but is still standing. But I think the bigger question has always been, what's the succession plan? And when I hear you talking about all these moving parts, I do wonder how quickly can they execute on this succession plan?
So I think that it's still going to take some time to play out. Bob Iger still has a couple years left on his contract. They are making I think all of the possible successors more visible, be it Josh D'Amaro at the Parks or Dana Walden and Alan Bergman from the content side of things. Pitaro from ESPN, and they also have a very strong CFO that they just brought in last year from Pepsi, Hugh Johnston. Normally, they will be filling the role with somebody who's got some of the content chops, so to speak, from Disney. But it's something that's going to play out, I think, more so in the next year. But I think that they definitely need to make each of these executives more visible in order to help support the confidence among investors in terms of that succession plan.